Hello and welcome to Why Not Mint Money. This is Neil Borate from the Mint Money team. If you have watched shows like Shark Tank, I'm sure the thought has crossed your mind. Can I become a startup investor? And how much money can I make that way? We will try to answer all of these related questions in this video. So, first, let's turn to the question of how you can become a startup investor. Now, although there is always the unorganized route of doing so, the organized formal channel is to go through an angel fund. Angel funds are regulated by the Securities and Exchange Board of India, or SEBI. These funds, in order to be an investor in these funds, you need to have a net worth of at least 2 crores, which excludes the value of your primary residence, the home that you live in, and you need to either have prior experience investing in startups or you need to have at least 10 years of corporate experience. The minimum investment in such funds is 25 lakhs. Now, let's turn to the question of how you can, what are your chances of actually making money? Now, there are some platforms which facilitate startup investing for individuals, such as AngelList, Mumbai Angels, and Let's Venture that we spoke to. And they said that for their portfolios, if you take the past 7 or 8 years, their internal rate of return is 25 to 30%. Now, there is no way of verifying this figure, and you have to also take into account the fact that there is a bull market currently in both listed equities and startups, which would have pulled up this return. You might not get this kind of scenario in future blocks of 8 to 10 years. Now, you don't always have to wait that long. Often, a startup in its life cycle will move from angel funding to venture capital, and at that stage, you will be offered an exit by the venture capital fund, or if the startup is being acquired by another company in its sector by the acquirer. But of course, there are no guarantees. Now, the level of risk is incredibly high here, which is why some of the boutique wealth management firms that we spoke to said that they do not offer angel funding to their investors. Instead, they focus on later stages like Series A venture capital or even pre-IPO stage, which happens quite late in a startup's life cycle. Finally, let's talk about tax. So, a startup investment is an investment in an unlisted stock. So, if your holding period is less than 2 years, then any gains that you make by selling the shares are taxed at your slab rate, which could be something like 30%. After a 2-year holding period, the gains would come under long-term capital gains, which are taxed at 20%, and you also get the benefit of indexation. Finally, let me once again emphasize the enormous risk out here. One of the wealth management firms that we spoke to pointed out the issue of adverse selection. So, founders prefer to get their money in big chunks from big funds and big promoters. They only turn to larger groups of individuals when they are unable to secure this kind of funding. And the startups who are unable to secure this kind of funding tend to be those with, or can be those with, weaker business models. So this is also one big issue in individuals getting into startup funding. Thank you so much for listening, and goodbye.